All right, welcome back. It's the Avid Investor Podcast with me, your host, Josh Adamek, and here we are, episode 43. Today, we're going to talk about the potential pitfalls and risks and downside with investing in real estate. So last week, I talked about the quote-unquote new ways to invest in real estate, and I gave you my thoughts and opinions on that. And if you want, go ahead and circle back, check that out. It's still out there if you didn't get a chance to tune in. But today, I want to talk about the three main ways to invest in real estate and the potential risks and downsides and pitfalls associated with those. And I want to give you my thoughts and opinions on how to avoid and mitigate those risks and those downsides. So here goes. So just to recap on that and dive into it, there's three main ways to invest in real estate: wholesale, retail, and long-term cash flow. And today, I'm going to talk about the risks, the pitfalls, the downsides to that. And why is that? Because I live in the real world. I run a business. I have an investment company. I have a private equity company, and I have a team. I have a staff here, and we live in the real world. And in the real world, there are pitfalls, there are risks, there are downsides. Now, over the years, we've learned how to mitigate those risks and try to avoid the risks. And our focus has been safety and security while building our portfolios. But I want to talk about the pitfalls and the risks and the downsides because I don't see anybody else talking about it. And in reality, like, I don't have anything to sell you. I'm not here like giving you all the it's so easy. All you got to do is this, that, the other thing. Then, boom, you're a millionaire. Boom, you're making X amount per month. You got a Lamborghini, you got a big ass house. No, I'm not giving you any of that crap. Why? Because it's crap. Again, I live in the real world. I run a business, and a business requires time, effort, energy, and work to create something and to build something and to run and manage something. And again, I don't have anything to offer you. I'm not trying to get you to sign up for my course or, buy my book or, join my mastermind or come to my event or anything. Like, I got nothing here other than the information that I'm providing that will hopefully, help you in your investment business and your investment career. So, I feel the need, since nobody else is talking about it, let's talk about some of the downsides, some of the risks, some of the pitfalls that you're going to encounter in this business and how to avoid them. So as I mentioned, many times, there's three main ways to invest in real estate. There's wholesale, there's retail, and then there's long-term cash flow. And there's a bunch of different little spin-offs with each of those strategies, ways to structure deals and things like that, ways to structure your partnerships, your capital stacks, and debt, equity, whatever the case may be. But let's take a little bit of time and dive into each one of those aspects. And I want to talk about pitfalls and risks and downsides in each of those aspects and how to avoid them. So first off, wholesaling. Wholesaling real estate is basically, if you don't already know, which many of you probably do, wholesaling is when you have equitable interest in a property and you sell that equitable interest to another investor who's actually going to close on the property. Now, a lot of wholesalers do that via release agreement. Some it's not recommended, but some do an assignment type agreement. And then there are some, wholesalers that actually close on the property and then resell it to another investor. So there's different strategies there. But and wholesaling is in my opinion, there's a common misconception that wholesaling is the easy part of the business, that it's easy to do. And a lot of people that want to start in real estate start with wholesaling, see it as an easy way to get in the business. In reality, wholesaling, yes, there's low barriers barriers to entry, which means there's a high attrition rate. A lot of people get in, try it, doesn't work out. They get frustrated, can't find the deals, can't move the deals, and then, whatever, move on. So you see it. A lot of new people come, don't start putting huge numbers on the board, and then, they're gone. I mean, I can't tell you how many emails I get per day, how many calls I get per day from new wholesalers that are sending out deals that, quote unquote deals that just don't make sense. So here's potential risk, potential downsides with wholesaling. Well, first off, if you're gonna be a wholesaler, if you're gonna wholesale a property and you're meeting with a seller, and this seller is expecting you to purchase their home, to close on their home. If you make them a cash offer and you say, I'm going to close in 30 days, and you're controlling that property with a agreement of sale to purchase, then you're setting that seller's expectation that you're going to purchase that home. So in my opinion, you better follow through with that purchase. If you tell a seller that you're going to buy their home, you better be ready, willing, and able to purchase that home in 30 days, whether you have a buyer lined up or not. So you see that all the time with a lot of these courses from the quote unquote gurus that are out there that say, oh, well, you just use this agreement of sale, and then you have your contingencies in there where, it's subject to, buyer's partner's approval or, inspection or whatever, whatever the case may be, throw your contingencies in there. Well, that might sound good in theory, but in reality, you're setting a seller's expectation that you're going to purchase their home, that you're going to close on their home, and they're going to rearrange their life expecting that you're going to purchase that home. So if you go into an agreement of sale, you better be prepared to purchase that home. So, which means, you better have a good deal on that property. You better make sure the numbers and the ratios work for somebody to come in and purchase that equitable interest in that property from you. So that's step one. Step two is when you control this property, again, the numbers and the ratios must work. Wholesaling is not simply getting a property under agreement and then thinking there's a magical buyer out there that's going to pay you, $2, $3, $5, $10, $25,000 more than you got that property under agreement. So that's number one. And how do you get those deals? You got to market to the masses. You got to have your lead generation. It's not as simple as going out there and, finding a house on the MLS or finding a house on Craigslist or Facebook Marketplace or a for sale by owner. It's not a one and done. It's a numbers game. Wholesaling is a numbers game, which means that, there's companies out there, there's companies right here in Pittsburgh that are just huge wholesalers, and we buy a lot from them. Which means if you're going to be a new wholesaler, you got to beat those guys to the lead. You got to beat the companies that are out there with a full team, with a full staff that are spending, $5, $10, $20, $30,000 a month in marketing and lead generation, that are out there, boots on the ground every day, looking for houses looking for homes, looking for real estate to secure, to wholesale. So you got to beat them to the deal. And then two, you have to be able to beat their numbers, you have to, be able to get in front of that seller and have that seller comfortable enough with you and your company and your team and your strategy to go with you instead of the other guys. So, there's the negotiations that come into play. There's, showing your ability to perform, and ability to perform is huge. I mean, again, I can't stress it enough. If you're going to set a seller's expectation that you're going to purchase their home, you damn well better purchase their home. You can't can't secure a property with a bunch of BS contingencies and clauses in the sales agreement, and then a day before closing or a week before closing or the day of closing, call the seller up and say, I'm sorry, we're going to exercise this contingency in our agreement and we're not going to close on the property. That is a total disservice to a seller. So that's number one. That's on the front end. Number one, number two, wherever I was. So that's on the front end. When you're going to set a seller's expectation, make sure you perform. Then on the back end, when you've found that when you feel that you've secured a deal and you're going to pass that deal on to another buyer, you're going to release your rights, release your equitable interest, and you're going to pass that deal on to a buyer who's going to close on the property. You better make sure your buyer's your buyer's there, your buyer's good, your buyer's legit. So again, when wholesaling, and I've talked about this before, you want to be a wholesaler. So many of these gurus teach that you got to build this massive buyers list. You got to build this massive buyers list. You got to get 2,000, 5,000, 10,000 people on this buyers list. And then all you have to do, and this is what the gurus are teaching, all you have to do is go out and sign up a property, send it out to your buyers list, and somebody will buy it. Well, maybe that's true. Maybe that happens. Yes, it does happen, especially right now where we've been in an up market. So there's a lot of people that are buying, that are investing in real estate, buying properties that just don't make sense. But in reality, here's what happens. So, again, we're very active. My company's very active. We buy a lot of single family homes every year. We're kind of blinders on, laser focused. We invest in, regular houses, regular neighborhoods, single family homes. And, we buy a lot from wholesalers. So, and we have a buy box that, our deals are what we purchase has to fit within. It has to meet our buy criteria. So, when we go to a wholesaler, wholesaler sends a property out, we go look at it. Maybe we can buy it, maybe we can pay, what their price is, maybe we can pay a little bit more. Maybe we have to be a little bit lower. And a lot of times, we are a little bit lower than what the wholesaler sends it out, but there's plenty of times where we're at or above what their price is. So in the example that we're a little bit lower, we'll put our number in, and a lot of times wholesalers, especially a new wholesaler, they'll have this buyer that's going to pay them $5, $10, $20,000 more than what our number is. So they'll go with the other buyer. And this doesn't happen every time, but at least 5 or 6 times a year, if not more, wholesalers will call us up and they'll say, "Hey, do you still want this deal?" Whatever and they'll give us the address, and we'll say, "Yes, we can buy it at our price." And this will be a Wednesday or Thursday, and they'll say, "Okay, can you close tomorrow? Can you close Friday?" Yes, we can do it. We can walk through, we can check the property, make sure it's, in the same condition it was when we looked at it 3-4 weeks ago. And yes, we can close in a day or two. So that happens over and over and over again, many times a year. And why is that? Because when you build this massive buyers list as a wholesaler and you're dealing with people that you don't really know, somebody may give you a higher price on the purchase, but they may not always follow through. They may not have the ability to close. So when you're wholesaling, that's a big thing. If you're not in a position where you're able to close on that property and you don't have cash, or you don't have financing lined up, and you're expecting this buyer to purchase the home and close on the home, they better perform. And what happens if they don't perform? What's your backup plan? So things can go wrong. Things can go things can go bad when you're wholesaling. Now, you've got this seller that's expecting to close on their property on Friday. You've got this buyer who you think is going to close on the property. And then all of a sudden, this buyer gives you some excuse, or this buyer goes dark. This buyer disappears. And now you're standing there like, what do I do? And, the option is try to scramble, try to find not another buyer that can close quick, that's a real buyer, legit buyer, or two, you have to go back to the seller and one, maybe ask for an extension, or two, tell them you can't perform on your contract, and it puts you in a really bad spot. Maybe you don't feel like it puts you in a bad spot, but it should, because it puts your seller in a really bad spot. Maybe your seller already moved out of that home. Maybe your seller already, bought another home, and now they're up against, the cost of two homes, which maybe they can't afford. Maybe your seller, has some other life-changing circumstances where they needed to sell that home. Maybe they moved out of state and they just can't deal with it from afar. There's so many variables, and bottom line is, when you go under agreement with a seller, you need to be able to perform. So that's it. I mean, and there's so many different potential downsides, potential risks with wholesaling, but bottom line is if you're going under agreement, you better be able to perform. If you're going to work with a seller and you don't have the financing or the cash to close on that property, you better verify that your seller or that your buyer is legit and has the ability to close. And that goes back to building this massive buyers list. That, in my opinion, that's not always the best way to go about wholesaling. If you want to wholesale, consider this: find 2, 3, 5, 10 legit confirmed buyers, maybe like myself or companies like myself that are ready, willing, and able to purchase and always perform when they go under agreement. And then just go find the properties that those buyers look for, and feed their pipeline. So my company, when we go under agreement, when we say we're going to purchase a property, we perform. There's no excuses. There's no ifs, ands, or buts. If we're going under an all cash, going under agreement with an all cash, no contingencies purchase, we're going to perform. Maybe there's a time where there's a contingent on a sewer line inspection, or whatever. This doesn't happen often, but a septic tank inspection or something like that. There's that variable, but majority of times when we go under agreement, it's a cash purchase, no contingencies, and we have a 100% close ratio when we go under agreement. So it's very important that you stick to your word and you close if you're going to say you're going to close. So that's wholesaling. Let's talk about retailing, flipping, renovating. So with that, I mean, I don't know how much time you guys have, but this one can go on and on and on and on. When you talk about flipping real estate, renovating, rehabbing, retailing real estate, there's a lot of variables. One is, first and foremost, market conditions. You are buying a home. You're going to take 30 days to close on it. You're going to take, depending on the size of the rehab, you're going to take a month to rehab it, maybe 2 months, maybe 6 months, maybe a year, depending on how bad it is. And how big it is, how much work it needs. And then you're going to remarket the home for sale. So in that time frame, whether that's 30 days, 90 days, 6 months, 12 months, your deal is contingent upon market conditions. The sale of you're going to underwrite this deal up front when you get it under agreement, and you're going to say, I'm going to sell this home for X. Well, what if something happens in that 90 days, 6 months, 9 months, or a year, where the market changes, where banks stop lending, where something happens where that front end number that you underwrote the deal at isn't there at the end? That happens. So how can you mitigate that risk? One, regular houses, regular neighborhoods, multiple exit strategies. So if you want to buy, fix, and flip a house, and you're new to the business, start off small. start off small, and understand that if that home doesn't sell, you have to be able to do something else with it. If you're in Pittsburgh, regular houses, regular neighborhoods, median price points, you're buying with the correct ratios, max 65, 70%, max versus the end value. I wouldn't say LTV, but you may not have a loan on the property. So 65, 70% max of the after repaired value. You got your equity. You confirmed you have your equity. If you're in median price points, in Pittsburgh, that's, it changes, but that's somewhere around, 185 to 225. That's a median price point for the Pittsburgh market. If you're in that price range, you buy, renovate a home, and it doesn't sell. Maybe you mess something up. Maybe you were a little slightly wrong on your ARV. Maybe you went over on your rehab. For whatever reason, you get to the end of the transaction and it doesn't sell. If you're in the median price points, in the regular houses, regular neighborhoods, you can always rent that home out. You could refi it if you use short-term financing. Banks are still lending. You could refi that home, rent it out in cash flow. Now, let's say you're new to the business and you took one of these seminars and saw this YouTube video where bigger is better, blah, 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 do this big rehab, you get this $100,000 payday, make, 6 figures on this flip. And you go into a neighborhood, let's just say, Lawrenceville, East Liberty, Highland Park, whatever. You go into one of these neighborhoods where they have the big old homes, and, it's a full gut reno, and you're projecting, you're purchasing for X, you're projecting X on the reno, and you're projecting X on the resale. Well, first off, if you're new to the business, my opinion, you have no business doing a full gut renovation right out of the bat, unless, of course, you have significant experience in construction and significant knowledge of market conditions, values, price points, etc. So when you get into those big full gut renos, things happen. There's issues. You get in, you got the home, and you could find foundation issues. You could find, utility issues that you weren't accounting for. You can find, I've done this before where we got at a home and we found fire damage that was covered up from decades ago, but we expose it, so we got to fix it. So there's things that can happen. There's cost overruns. If you don't fully understand construction cost, there's variables. There's cost overruns in construction. If you get into a project and you want to do a full gut remodel and you miss some things on your reno. If you're starting with $100,000 reno budget, it's very easy on a full gut reno to go 10, 20, 30, 50% over your rehab budget. It can happen. It can happen. So if you're putting all your eggs in one basket right out of the gate and starting this full gut reno, I mean, you can run into some problems. And then when it comes to the back end on the sale, on the price point, let's just say there were no issues as far as market conditions. The market remained stable. The market remained the same. What if you didn't properly underwrite that deal out of the gate? Many people know that, Pittsburgh, and you may not know this if you're new to the business, but price points in Pittsburgh are very specific. There are neighborhoods and there are parts of Pittsburgh where it's not like pocket by pocket price points, but it's street by street where values change significantly. There's parts of town where you get past a certain street in a neighborhood, the values change significantly, or different elementary schools in certain neighborhoods are big bumps in value. So if you don't know these things, if you don't fully understand these things, and you're just looking at the big picture, and you're seeing your comps, oh, well, there's a 500 here, there's a 550 there's a 575 here, Mine has to be 550. Well, what if yours is 3 blocks away? Yes, it's in close proximity, but what if your home is in that other elementary school that's not as desirable? Or what if it's past that street where there's a big bump in value? So if you miss things like that up front, it can make a big difference, big difference. So if you're putting all your eggs in one basket and one big remodel, that can be a mistake. So when it comes to, again, just to summarize, when it comes to rehabbing and flipping homes, if that's the model that you choose, start off small. Start off with a basic starter home. And go through the process, learn the process, do a few of those, and then build up to the bigger homes. But again, I can't stress this enough. Whether you're wholesaling or whether you're flipping and selling retail, you want to focus on long term, which is what I'm going to talk about next. If you're making some money wholesaling, if you're making some money flipping houses, don't go out and buy dumb shit. Focus on building a long-term portfolio, building up that passive income. And that's what I'm going to talk about now is investing for the long term, investing in cash flow properties. And what can go wrong with cash flow properties? Well, there's a lot of potential downsides and potential pitfalls with being a landlord, with renting homes, with investing for the long term. How we mitigate that risk is, we invest in regular houses, regular neighborhoods. We call it grandma's house, but again, median price points for the Pittsburgh market, 100 and a lot of our homes in portfolio are in that like 150 to 225 value range. That's what we invest in. We don't do any low income Section 8 properties because, again, some people see that coming into the business. It's like, well, I could just buy these Section 8 houses for $20,000 and they're going to rent for $900 a month. And I will be the first to tell you that everything looks good on a spreadsheet. There's when it comes to low income housing, they can potentially be cash flow, cash cows, cash monsters, whatever you want to call it. Looks great on a spreadsheet. But again, as I said in the beginning, we live in the real world. Real world is low income housing requires a lot of management, a lot of oversight. Are there some good folks in low income housing? Yes, absolutely. There's good folks in any part of the market, anywhere you go. There's also bad folks in any part of the market, anywhere you go. But if you're looking at solely building a portfolio of low income housing because you see how great it looks on a spreadsheet, quote unquote, you're going to be in for some a lot of management. And then if you go into the upper end of the market, the higher price points, in Pittsburgh, that would be, 250, 300, 500,000. If you're going into the upper end of the market because you see that, oh, well, I can buy one house and it's going to rent for, $3,500 a month, or $3,000 a month, or $2,500 a month, or whatever those numbers are, and you're seeing that, if you're seeing that, I can finance this home for, I can get a 30 or more, whatever. However, you're underwriting that deal, and you see value in that upper end. Just keep in mind that if you're renting a big home in the upper end of the market, first, the person that leases that home, their expectations are going to be here. They're going to be way up there. It's like, well, I'm paying this much to rent this home. It has to be perfect. So with that, you put somebody in there. Let's say it's in a good school district, an A school district. There's family, kids, everything. Well, in reality, homes get beat up. That's just what happens. It doesn't matter who you are, what market you're in. Things happen. Homes get lived in. And when people move out, you have to turn those homes. So if you're in that upper end of the market, your turn costs are going to be super, super high. If you're leasing out a 3,500 square foot home, and somebody moves out, walls got all beat up. I mean, what's it cost to paint one of those homes? to repaint it. You're not going to have to cut trim and everything probably, but you're probably still $10,000-$15,000 to paint that house. So then you're looking at flooring, you're looking at, window treatments, all kind of stuff. So in the higher end market, you get somebody that moves out and the home's a little bit beat up. It could cost you, $20,000-$25,000 to turn that home. So, and then, those higher end homes, regardless of whether you're buying or leasing, I mean, they're subject to market conditions. So, when the market's good, people don't mind, people that make a lot of money don't mind spending, a lot of money on, to rent a house. But when the market's not so good, there's a job loss or something in the family, they're going to go back to, the B-class neighborhoods, the regular houses, regular neighborhoods. So when it comes to long-term, that's what we invest in, is just regular houses, regular neighborhoods. Our average home is 1,200 square foot. If somebody moves out, gets beat up, turn cost isn't super high. We can do it relatively quickly because it's not a big house. It's not a big job, and we turn the home, we move somebody in. And then, we spread the risk reward over multiple houses, over a lot of homes in our portfolio, rather than doing 1, 2, 3, 4 homes. We'll buy 5, 10 homes in that portfolio, and we spread the risk reward. So when you talk about turnover costs and turn and loss and things like that, when you have 10 homes in a portfolio and one goes vacant, and you have to turn that, and the cost is minimal, versus you have 2 homes in that portfolio and one goes vacant and the turn cost is high, there's a big difference in those ratios. So it's all things to consider. When it comes to long-term investing, being a landlord, there's probably a whole nother podcast there, a whole nother episode that I could do on, property management, dealing with non-pays and renewals and things like that. But, for that, I think that's probably best saved for another episode. But again, how we mitigate our risk and potential pitfalls and potential downsides in our long-term portfolios is through buying regular houses in regular neighborhoods and leasing them to, regular people that can and want to live in those areas. We don't do Section 8 house. We don't do, we don't focus, and we don't do low income housing. We don't deal in the A neighborhoods, where median price points for the Pittsburgh market, B-class neighborhoods, regular houses, regular neighborhoods. Grandma's house is quote unquote, that's what we call it. That's what we look for to buy to keep in portfolio, is grandma's house. So that's it. I just wanted to cover the 3 main aspects of investing in real estate: wholesale, retail, and long-term cash flow, and talk about the downsides. Again, the potential risks and the pitfalls. Why is that? Again, because nobody else does. I really wants to talk about the highlight reel, how great it is, how easy it is, how quick it is to get into real estate, and how much money there is to be made. Everybody wants to talk about that, but nobody wants to warn you on the potential downsides, the potential risks, and how to avoid them. So with that, I thank you guys for tuning in. Thank you for listening. Again, I got nothing to offer here other than some thoughts and some guidance here on running a business, investment company, and investing in real estate. So if you find value in this message, all I ask in return is share it. Send it to somebody, copy the link, send it over text, email, share it on social media, whatever. Just help me spread the word. And as always, let me know let me know what you think. Give me some feedback. And if there's anything that, you'd like me to talk on in more detail, go through, please reach out, let me know, call, text, DM, whatever. But again, thank you guys so much for tuning in, and have a great day.